Around 70,000 people lose their jobs almost overnight. At the same airline, a big part of that comes down to oil. And this isn't one airline, it's the same force that is about to show up somewhere much closer to you. You have probably heard the word stagflation before. The last time we really saw it was in the 1970s, and it took years to work through. People like Ray Dalio have been saying recently that the condition for it might already be in place. Ray Dalio, Bridgewater Associates, his exact words to CNBC last Monday. So, in this video I want to walk through what stagflation actually is, what is different from a normal recession, and why this kind of environment is so difficult for the Fed to deal with. Most people recognize the term, but don't always understand why it is such a problem. It's not just an inflation, and it is not just a slowdown. It is both happening at the same time. One way to think about it is like pressing a gas and the brake in a car simultaneously. The tools that usually fix one side of the problem tend to make the other side worse. If the Fed raises rates to fight inflation, that can slow the economy and increase unemployment. If they cut rates to support growth, that can push inflation higher, especially if the problem is coming from the supply. Every decision solves one problem and quietly makes the other worse. Every solution creates the second problem. Now, it is not that they have a zero option, but the room to maneuver is much tighter than a normal cycle. Once people start to believe inflation will stay high, behavior change. Workers push for higher wages, companies raise prices to protect margins, and that feedback loop can reinforce itself. At that point, breaking the cycle usually requires tighter policy, sometimes enough to push the economy into a recession. That is essentially what's happened at the end of 1970s, when Paul Volcker raised rates very aggressively. It's eventually brought inflation down, but at the cost of the deep recession. Ardini put it simply, the Fed is stuck between two problems that require opposite solutions. That's not a rhetorical, that is actual policy structural right now. The current data, PCE above the Fed is 2% target. GDP revised down to 0.7 in quartal fear. 92,000 job lost. The free conditions, not the predictions, already in the numbers. So when you look at the current data, inflation is still above target, growth is slowing, and some sign of weakness in the labor market. You can see why this topic is coming back into the conversation. And if this is already starting in data, the part most people are missing is where it show up next. That is where oil become a problem, not at the pump, but in everything that comes after it. The airplane example is just one visible case. But there are a lot of businesses that operate on thin margins and rely on stable fuel cost. When diesel or oil prices rise sharply, these margins get squeezed. Some companies can absorb that for a while, others can't, and the impact often show up gradually. Smaller layoffs across different industries, until it starts to show up more clearly in aggregate data. Spirit is a useful example because it makes the mechanism visible. Jet fuel is a direct derivative of a crude oil. When crude goes up 40%, jet fuels follow. For businesses already operating on thin margin, that's often the difference between viable or not. The same logic applies across trucking, logistics, farming, manufacturing. The effect accumulates through smaller businesses first, often before it shows up macro data. Another important piece is timing. When oil price rise, The effect on food price usually comes with a delay. It can take a few months for higher input costs to work their way through the system. So even if consumers don't fully feel it immediately, the pressure can already be building in the background, depending on how long energy prices stay elevated. And by the time it shows up in the data, it is already too late to stop it. But what about strategic reserves? Can those offset some of this? They can help at the margins, but the strategic petroleum reserve was already near multi-decade lows before this started. It was drawn down significantly in 2022, and there is a practical constraint on the release rate. So the physical infrastructure limits how quickly you can move reserves into the market. So it is a tool that can take some pressure off. But it is not scaled to offset a sustained disruption of this size. Think of it as a pressure valve rather than a fix. Vanguard's April 2026 research note: the ripple is already moving through the system. Here is the part I promised, the 1970s comparison, and why the difference matters as much as the similarities. In the early 1970s, oil supply shock pushed prices higher while growth was already slowing. At the time, the Fed was concerned about the economy weakening, so policy leaned more accommodative. In hindsight, that contributed to inflation becoming more entrenched. The mistake wasn't that they acted, it is that they acted in the wrong direction at the wrong time. Eventually, much more aggressive tightening was required to bring it back under control. Now, to be fair, today isn't identical as 1970s. The US energy position is different. It's no longer as dependent on imports as it was back then. They can offset part of the shock. Vanguard made this point explicitly. The US cushion in 2026 that didn't exist in 1973. There are also arguments that productivity gains, for example the technology, could help reduce inflationary pressure over time. And of course, a lot depends on how current geopolitical tension evolve. If energy prices come back down, some of this pressure could ease. So there are multiple paths from here. So reason this get attention is that under certain conditions, policy mistakes during a supply shock can make inflation harder to control later on. If policy gets this wrong, it doesn't show up immediately. It shows up a year later. And if the dynamics start up repeating, it doesn't show up as a crash. It shows up as something much slower. What makes this particularly difficult for the incoming chair is that the political pressure and the economic logic point in the different direction. There is a clear preference from the administration for lower rates. At the same time, cutting rates into a period of energy driven inflation carries real risk, as the 1970s experience showed. Neither path is without cost. The question is which trade-off is more manageable over time, and that's a genuinely ancient. And to be clear, there are genuine reasons this might not follow the 1970s path. The US energy position is different. As a net oil exporter, it is less exposed to an import shock than it was in 1973. Vanguard noted this explicitly. Higher oil prices hurt consumers, but benefit domestic producers, which partially offset the aggregate impact. There is also the productivity argument. If AI-driven efficiency gains are genuinely disinflationary, the relationship between rate cuts and inflation may not behave the same way it did historically, and geopolitical situation can resolve more quickly than expected. If energy prices came back down, much of this pressure could ease before it becomes entrenched. So there are multiple reasonable paths from here. The reason I think the risk is worth watching closely. is that the conditions for a more difficult outcome are present, not that the outcome is determined. Kellogg economists on the specific 2026 risk, not a prediction, a mechanism under certain conditions. So what does this actually feel like in your specific financial life? Because stagflation and a regular recession feel different day to day. In a standard downturn, demand fall and price often come down. Cash holds its value better and some assets become cheaper. In a stagflation type environment, you can have rising prices alongside weaker income growth or job security that create a squeeze. Your expenses go up, but your financial cousin doesn't improve. That is a part of why the 1970s feel so difficult for households. Not everything was collapsing, but affordability kept getting worse, and that kind of gradual pressure can be harder to respond to than a sharp, obvious downturn. And that is exactly why the 1970s caught people off guard. Not because everything collapsed, but because nothing did. Some of the squeeze is visible in current data. Consumer credit levels are near all-time highs. Savings rates have declined. GDP growth in quarter 4 was revised down to 0.7%. These don't individually confirm stagflation, but taken together, they are consistent with an environment where consumers are under pressure from both sides simultaneously. Income growth that isn't keeping up with cost, and less buffer to absorb further increases. And that combination, rising costs alongside weaker income growth, is structurally different from a standard recession. In 2008, if you held cash and keep your job, you were relatively insulated. Prices fell, assets become cheaper. The downturn was painful, but it had logic to it. Things got cheaper as demand fell. In a stagflation environment, cash loses purchasing power, while job security weakens. There is no safe corner to wait it out in. That's the specific difficulty of this situation. Gallup confirmed it, not market volatility, not recession risk, affordability. Number one concern. Looking back historically, different assets behaved very differently during that period. In real terms, after adjusting for inflation, equity returns were relatively flat over much of the decade. That doesn't mean market crashes. It means nominal gains were offset by rising prices. Meanwhile, real assets like commodities and real estate tended to hold value better in that kind of environment. Cash and fixed income assets, on the other hand, struggled when inflation stayed elevated. And that is what makes it dangerous. Nothing looks broken, but you are still losing ground. You don't lose money fast. You lose it quietly. Kellogg Northwestern, an entire decade, flat in real terms. It is worth being precise about what flat in real terms means, because it is easy to misread. Nominal equity returns in 1970s were positive. Market went up in dollar terms, but inflation was also running at 6, 7, sometimes 10%. When you subtract inflation from the nominal returns, the real gain was close to zero over the decade, which means portfolios looked okay on paper, but the purchasing power behind them wasn't growing. That's a distinction matters, because the experience doesn't feel like a crash. It feels more like running to stay still. So, to sum it up, stagflation is a combination of rising prices and slowing growth. That combination makes policy decision more difficult, because tools that help one side can hurt the other. Some of the conditions we are seeing today, especially around energy and inflation, overlap with patterns we have seen before. At the same time, there are also important differences. and the outcome isn't predetermined. But here is the thing that worth holding on to. Stagflation isn't when things break. It is when things stop getting better and keep getting more expensive. No crash, no obvious moment, just a slow gap that opens between what things cost and what your money can do. If you like a video, leave me a like and subscribe so you don't miss next video. And drop a comment, do you think this is already stagflation or not yet? I read everything.